I'm Zeke Kelly, founder and principal advisor here at Canopy Financial Solutions. Thank you for joining me here on this investment strategies deep dive. For efficiency and time's sake, I'm going to do us both a favor and use the script today so we can stay focused and on point. The purpose of this video is simple. I want to illustrate my value proposition to you so you understand what makes my firm unique amongst a pretty damn big industry of folks who are all competing for your trust and more specifically your assets. You can follow up or follow along with these topics on my website, canopyfinsol.com. From the homepage, simply navigate to the pillars dropdown, and that very first link, investment strategies, is going to be the topic of this video. So my main goal here is to educate you and provide transparency on a process and approach that, quite frankly, I'm very proud of, and I'm excited to share with clients and prospective clients because, yes, I would like to earn your business. But I genuinely believe that you would be better off working with me and my firm on your investment objectives. That's not just wishful thinking or overconfidence. In fact, me and my family's personal assets are invested right alongside of my clients. So literally, my money is where my mouth is. I've worked across the financial services and wealth management industry. And during that time, besides being terribly underwhelmed with the fancy departments and pretentious advisors, I was pretty shocked at the lack of competence combined with the abundance of complexity. So not only did that experience lead me to starting Canopy Financial, but it allowed me time to develop and refine this very investment philosophy and approach that I'm describing to you today, where the core focus actually is on investment performance. So I get it. Wealth management, it's not a singular focus. And yes, we do address our clients' holistic financial planning needs. But let's be honest, investment returns are the single biggest driver of your ability to retire well. That focus is what makes us unique. Sadly and surprisingly, this is not true of most of the industry, especially the average advisor out there who is merely gathering assets and then outsourcing them to some mass-produced model that will likely never beat the market, nor will it significantly protect you when you need it the most. And that's when markets fall. Why is that? Well, if you've worked with other advisors and institutions in the past, you've seen this directly in your investment statement. So what you typically have is an overly diversified portfolio that basically tries to have exposure to everything. So if one asset class falls, you're not significantly impacted by that. But that also means that over diversification and dilution, it also prevents you from achieving significant upside gains. So that idea that diversification and asset allocation is the key to reducing risk just doesn't sit right with me. So don't get me wrong. I also believe in diversification of investments and asset classes. However, the key difference is that rather than reducing risk through over diversification and dilution, we seek to proactively avoid risk through the use of our technology and alternative strategies. So this is a huge divergence from the driving factor behind portfolio management today, which is based on a 75-year-old concept called modern portfolio theory that I briefly talk about here on my website. The bottom line is, yes, we have come a long way since the mid 20th century when computers were barely in existence. So I think it's time that asset managers are held accountable to their clients for repeated underperformance, especially when a do-it-yourself investor can beat 80% of the industry professionals out there. All right, when it comes down to it, there are really only two distinct investment objectives: growth and income. You need to grow your assets for the future, i.e., retirement or some other goal beyond the present, or you need your investments to produce income cover your basic living expenses and other wants, wishes, or discretionary needs. And by the way, just because you might require current income now doesn't mean that you should become totally risk adverse and stop growing your assets. Think about it. If a 35-year-old investor or family had 30 years until retirement, we would easily say that they need to remain aggressive to grow their money for the future. But most generic asset allocation models today, they become overly conservative that moment an investor reaches his or her retirement year. So even though a 65-year-old might live another 30 years to become 95, that money will probably not last because they never were told or realized that a portion of their retirement savings needed to stay fully growth oriented. So that's exactly why I address these equally important objectives of growth and income independently, rather than the typical single asset allocation portfolio that's made up of some arbitrary stock to bond ratio that is really based on something as simple as your age and expected retirement year. So growth is achieved by owning equities, whether it be shares of individual stocks, exchange traded funds, or mutual funds, or even physical and real assets. The bottom line is growth is invested in securities that are intended to appreciate in value. Income, on the other hand, can be achieved from a variety of sources and securities. One, through debt instruments, like in the form of bond coupons or bond fund distributions. It can be achieved through equity income vehicles like dividend stocks and funds. Or lastly, from the use of slightly more complex features known as derivatives, which can help enhance overall yield or income while simultaneously helping to reduce risk. Again, I'll go into more detail on some future videos in some of these specific methods here. But with all that in mind, I've created 3 primary solutions to simplify, the approach and help investors achieve both their growth and income objectives more effectively than I believe any one traditional portfolio model could. To go a little bit deeper into these customized strategies, first is dual defense tactical momentum portfolios. So this is kind of our bread and butter. This is my primary and preferred method for achieving growth and alpha for my clients. Alpha is an important measure. It's simply a measure of overperformance against a benchmark. That benchmark might be the aggregate bond index or the S&P 500. Regardless of the aggressiveness of any portfolio, all 4 versions of our dual defense portfolios are designed to achieve significant alpha against their benchmark. The second customized strategy is structured investments. These are actually they're less known to average investors, but structured investments are pretty common and were typically offered to only ultra high net worth and accredited investors in the past. Fortunately, have the means and the resources to scale these down and offer them to everyday investors like you and me. So I prefer these as a method to help investors achieve enhanced yields, meaning higher levels of income for those who require fixed or regular payments to cover their current living expenses. Structured investments can also be an attractive growth alternative, especially for clients and investors who are a little bit more risk adverse, and they're okay with sacrificing a little bit of that upside growth and also some liquidity in exchange for downside protection and that peace of mind. Lastly, third approach we offer, I call thematic portfolios. So these are simply more traditional buy and hold type of strategies. They're focused around a certain topic or theme, though, like dividend growth, deep value, dogs of the Dow, or perhaps it might just be a very specific segment of the economy that a client just really likes to own. So these are more static portfolios, and they're intended to be held for the long term and during bouts of volatility along the way. These also are more favorable approach for some brokerage or taxable investment accounts because it does limit the amount of trading, which can then trigger realized capital gains and some other tax obligations. So there you have it. That covers my general philosophy and approach to investment management using three specific methods to help you achieve your growth and income needs across a variety of account types and economic situations. So thanks again for joining me. I hope you'll continue exploring the website to learn more about each of these approaches. You can also check out my YouTube channel where I have videos like this and others, and listen to me explain each one of these approaches in more detail. So remember, there's no extra dollars or points awarded for overly and unnecessarily complex methods or jargon. Sometimes simplicity is the ultimate sophistication. That's my goal here at Canopy Financial Solutions. Thanks for joining me.